We are going to be talking about risk management. If you're a trader, you should know that risk management is very important in trading. All right. And not just even in trading, in every walks of life, it doesn't even matter whatever career you are into, you always have to evaluate risk so that you can make appropriate decisions where necessary. So let's begin. Risk management in trading involves identifying, assessing, and prioritizing risk to minimize their impact on investment portfolios. Of course, we are talking about trading. We are talking about money. So we need to do or manage money properly, right? Because in trading, the honest truth is we are going to lose sometimes. But over time, what you want to achieve as a good, solid trader is you want to come out profitable over a long period of time. It could be maybe over 10 trades, it could be maybe over 20 trades. So you need to have proper risk management in place to be able to last the test of time in the market. Now, key components of risk management in trading includes position sizing. Well, position sizing determines the size of each trade in relation to the total capital. This involves deciding what percentage of trading capital to risk on a single trade. So now what this means is, let's say you have a $10,000 capital. You don't want to go into the market and risk all those $10,000 on one trade. You want to implement proper risk management. So you want to allocate a certain amount of capital on that particular trade. Whether you participate in sports betting or not, I'm talking based on Nigerian setting right now. When you stake a certain amount on a particular team to win the match or not, you are willing to risk that money. You are not going to go and mortgage your house or sell your car. I know some people, they become so addicted and it leads to that. But like, let's say you want to approach it responsibly. You won't do all of that, right? Because you probably have family to take care of. You have bills to pay, right? So you won't go and break your bank and put all that money on a particular team to win. I mean, you are not the one playing the football match, right? So the same applies to trading. You don't want to risk your entire capital on a single trade because we are not the owners of the market. As a matter of fact, we don't move the market. We rely on the bigger players, the bigger boys, the hedge funds, the central banks, right, to actually pump in money to move the market, right? What we are basically doing is taking position, executing on our statistical edge over the markets to be able to make a profit. So sometimes we take losses. I mean, central banks also take losses sometimes, right? They may maybe analyze a particular transaction and they probably didn't execute it well, maybe because of one human error here and there. But whatever, they also incur losses. So we should also expect losses as retail traders, right? Then position sizing helps control the impact of individual trades on the overall portfolio. By portfolio, we are talking about your capital, and prevents large losses from a single unsuccessful trades, right? So we need to think long term rather than thinking on a particular trade, right? Because yes, we can have an edge, we can have an execution strategy to actually jump into a trade, but we cannot determine the final outcome of that particular trade. So there are different tools that we can use to calculate risk in trading, right? Let me just show you one of those tools. So let's just Google risk management calculator. Then you can see we have different options to choose from. So I'll just go with this. Let's say the pair you are trading is Euro USD. Then you want to choose your account balance, right? The currency of your account. Then the account size now is your capital. So let's say you have a $10,000 account. Let's say on this 10K account, I want to risk 1%, which is what I do most of the time. Let's do 15 pips. Then this doesn't really matter. So you just hit calculate. So what this does is it's telling you that the money you are going to be risking on this trade is $100, right? What is 1% of $10,000? 1% of $10,000 is $100. So this looks like the odds, right? The odds on that particular betting, what you are betting on, right? So in Forex, it's called lots, right? So this is the particular size with which you are going to execute that trade. So if you execute that trade with this particular size and this particular amount of stop loss in pips, then if the trade goes against you, this is your capital. This is what you'll be losing. I hope that makes sense. And we are going to come to risk to reward later. Then maybe I'll bring you back to this calculation, but stick with me. We are getting there. So this is a picture of my chart where I actually execute trades. So you can see I have a calculator here, right? It's a software. It's free. I downloaded it from nforex.com. So it automatically detects my account balance, right? And all I need to do is just to put in the risk that I'm willing to take per trade. As you can see, per trade, I'm risking 0.8% per trade, right? So automatically, if I hit stop loss, I'll be losing $1,686 on this particular trade, right? And then this is my lot size here. Now, what are the key components of risk management? So key components of risk management in trading includes number 2, stop loss orders, right? Now we have stop loss orders in place so that, let's say we get into a trade and we are wrong. Because like I said earlier, sometimes we are going to be wrong. We want to be more right than wrong. And how can you do that? Is by acquiring the skill. So when you get the skill, then you develop this edge over the market so that you know that, okay, even if I place 100 trades and I lose 40 and I win 60, I'm still profitable. So you need stop loss orders in place so that when you are wrong on a particular trade, you are willing to take a small loss, right? So that you live to fight another day and make profit. Now, placing stop loss orders defines the maximum acceptable loss for a trade. A stop loss order automatically exits a trade if the price reaches a predetermined level, limiting potential loss. Now, number 3, risk to reward ratio. From here, I'll take you to my chart. Positive risk to reward ratio means that potential profits are greater than potential losses. Let's say if you're risking $1, your reward is $2. So what this does is, after 100 trades, you lose 50, that's minus $50. You win 50, that's plus $100. So even though you lose 50 and win only 50, you will be up $50. I hope that makes sense. So good traders often aim for a favorable risk to reward ratio to ensure that winning trades can compensate for the losing trades. So now let me take you to my chart. Let's go practical. Let me just show you an example of some trades I took last week and even the weeks before.
Yeah, I have a question.
Okay, go ahead, sir.
Yeah, so talking about this risk to reward, what's the minimum ratio you need to have in mind for you to be profitable? For example, you said 2 to 1. Is 2 to 1 like the minimum ratio to consider?
Okay, perfect. So I used 2 to 1 because that's what I use personally. You understand? So there are traders that go for 1 to 3 risk to reward. There are traders that go for 1 to 4, 1 to 5, 1 to 6. In fact, sometimes some of my trades, depending on my analysis, let's say I was willing to take a 2% reward for a 1% risk. What I usually do is, sometimes when I look at the analysis, I'll be like, okay, you know what, I can extend my reward, right? So I could decide to change my mind. Instead of taking 2% reward for a 1% risk, I'll decide to hold for a higher reward. So if you can do 20% after 10 trades, you're a good trader. So you need to focus, okay, after trying your strategy using historic price action, how often are you right? How often are you wrong? I want to show you. I did this last week, right? I showed you my performance on this particular account. I told you it's a prop firm account that I got, a 200K account, blah, blah, blah. I took you to the website. I showed you everything. And that last week price was around here. This was the last trade I placed that last week, right? I'll take you to the chart, how I was able to generate the signal to actually come here to place the trade in a bit, just to show you how to manage your risk to reward. And you can notice that last week, this was the first trade I placed last week, but I didn't make a profit because price didn't move in my favor or even against me. And it was the trading session was moving into the period where I actually don't like to trade. So I just closed the trade at break even. So I didn't make a loss. I didn't make any profit on this trade. Then the next trade was a loss. You can see it here. The next trade was a loss, but later that week, I was able to recoup it with this particular trade here, as you can see. So now, what can you notice? If you look at all my performance on this particular account so far, last week I told you about how I got the account around November and I started trading it in December, blah, 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 and all of that. So what can you notice? Look at my wins, then look at my losses. My losses are smaller than my wins, right? And that is why I'm actually up on this account a little over 5%. Let me take you to my chart and show you how this risk to reward thing works. So this is TradingView. It's a software where we analyze price movements and all of those stuffs, right? So this was the last trade I took. So this is the size of my risk. All right, there's this tool where you can visually see what your risk looks like and what your reward looks like on TradingView. Right, so this is my risk. This was the trade I actually lost last week. This was the first trade I got in here. Price moved in my direction for a bit, but because I was going for a risk to reward ratio of 2:1. So this risk zone here is 1. So my reward is twice the size of my risk. Right? So, and that is why you can see that even though I took 1 loss and 1 win last week, I still closed the week with a profit. The profit should even be bigger than this, but I don't want to go into the reason why is this small. There was a news release at the time. Price came into my target, but for whatever reason, the spread was wide. There's something called spread in the markets, which time will not permit me to talk about. So the spread was wide. It didn't close me out. So it started going back up. Then I waited for it to come back a little. Then I just closed it manually here, right? But still, the profit is larger than the risk. So this is how you make money. Last week, I talked about my previous trades. I talked about my wins and all of that. Let's look at this January here, 8th of January, this initial 2 wins back to back that I had. This was it here. You see that my stop loss were in place. Or let me say my stop losses were in place, right? If I come back here, if you see, this were the trades I took, right? 1 sell, 1 buy, right? If I put my mouse here and you look at the black label below, you'll see that it's on Monday, the 8th of January. So this was how I was able to generate my signal, and I went here and I placed the trade, and that was how I was able to win the first trade here, which was also on the 8th of January. This was the second trade on the same 8th of January, right? So what can you notice? I had my stop loss in place. So in my head, I was like, okay, I'm jumping into this trade. I want to take profit here, but if I'm wrong on that particular trade, if price comes here, then I want to take the loss. Last week, there were no much trading opportunities. This was the first trade I took that I didn't make any profit, right? Around here, it was a sell trade. That means I was like, I wanted price to drop, but price was playing around here. So price now moved into a session where I'm not comfortable trading in. So I just closed at break even. But if I had held, I would have made more profit last week, right? Because obviously, as you can see, price came to my take profit area, but It is what it is, right? So these were now the two actual trades I took last week. One loss, one win. Just look at that. One loss, one win. And I made more money than my loss, right? The first one was a loss, minus 1,700. The second one was a winner, plus 2,500. This was supposed to be 3,000 plus, but I already talked about why I closed it at this price, right? So just a quick recap. Risk to reward is what is going to keep you in the game over time. Okay, please go ahead, please. Ask your question.
So my question is about the risk to reward management. So let me say, now, where does greed comes in the sense that I place a trade on a 2-to-1 ratio, and does the greed come in when, right now your chart, you said the first one, it's kind of, the take profit is kind of smaller than, yes, that one, the take profit is kind of smaller than the next one. So is the greed, let me say I'm trying to take a lot of profit and I move my take profit way down. Is that where the greed comes in, or the greed comes in at my stop loss is where maybe my stop loss is way too small?
Okay, you know what? This particular question depends on the trader, right? For me, I look for certain kind of setups. Like, I don't have a predetermined stop loss. So there are some people that will tell you, okay, my stop loss is a consistent 15 pip stop loss, consistent 20 pip stop loss per trade, consistent 30 pips. My stop loss is not consistent. I hope that makes sense. My stop loss is not consistent. That's how I trade. I trade based on the setup that I'm seeing in front of me. Of course, the rules are the same, but the stop loss is not consistent. In this case, my risk is 7.5 pips, so my reward will be 14 pips. You understand? And now, to answer the question of why is this smaller than this, like I said earlier, is because I don't have a predetermined amount of stop loss in pips. So my stop loss is determined by what the market is giving me at that particular point in time. The entry criteria is consistent, but the stop loss value is not consistent. I just like to put my stop loss at the most recent swing highs or swing low. So overall, effective risk management is an integral part of successful trading, as it helps traders survive the market fluctuations and downturns, preserving capital for future opportunities. Trading without proper risk management can expose individuals to significant financial losses. And why is that? Simply because, like I said earlier, you cannot determine the outcome of one trade. Yes, you can determine the outcome of 10 trades. You can determine the outcome of 100 trades, but you cannot determine the outcome of one trade. You don't know if this trade is going to be the losing trade or that trade is going to be the winning trade. I focus on what I can control before getting into the trade. So what can I control? I can control my risk, but I can't control the outcome. No one knows the outcome of one trade. No one. And that's just the truth. No one. Many beginner traders don't like to accept losses because they want the feel-good factor. I mean, when the trade is going against you, you want to adjust your stop loss because you don't want to take a loss because you want to feel good. Then, when price is going in your favor, instead of you to wait for price to go into a positive reward for you, let's say you are risking $1,000. You see traders willing to take a $500 profit, but you are willing to hold a $1,000 loss, but you are not willing to be patient for something above a $1,000 profit. So they take a $500, they are risking $1,000, but they are taking a $500 profit. Why? Because they want to feel good. FXCM is the name of a broker, one of the best brokers in the world. They conducted a survey on 20 million live accounts, not demo accounts, live accounts. 25 million live accounts. So they conducted a survey. The result was the winning trade, the average winning trade across those 25 million accounts were 62 points, 62 pips. But the losing trades were 80 something, 82 or 83, I can't remember right now. I would have added that screenshot here. I have a screenshot on that, where the losing trades was 82 points, 82 pips. And they were all losing traders, right? But what can you notice? They won more than they lost. But when they were right, they didn't maximize their profit. They were taking profit too early, but they were holding losses. And that is why statistically 95% of traders lose money, right? So before the giveaway, let's hear from our CEO. I don't know if he's on the line. If you still have any question, I'm more than happy to answer them.
So my question is regarding the classes.
Okay.
So like how many days in a week is it going to be holding?
Classes is going to be for 3 days in a week. Fridays, Saturdays, Sundays. For 2 months. Meant 8 weeks, sorry. So it's going to be 2 hours per session. Same time, 8 p.m.
Oh, okay.
There are 2 ways you can learn trading, right? There are 2 ways you can learn trading. You can learn it on your own, but it's going to take you longer, right? You need to dedicate 5, 6, 7 years. Myself, for me, it took me 4 years to start seeing profit. Not crazy profit, but it took me 4 years because personally, I didn't learn from anyone. I went through the pain, and of course, I lost lots of money. So it was until I became profitable, I now realized the importance of getting mentorship and stuff like that. I wish I knew earlier, right? So for me, it took me that long, right? And I've also seen traders that go from 0 to 6 months to becoming profitable, 0 to 3 months to becoming profitable, and all of that. But it all came through mentorship. So it depends on your pocket, right? If you can afford mentorship, by all means, I promise you, go for that. There are funding companies that are willing to give you an account, just like this account I'm talking about. Our time will not permit me to go into all the details. I actually purchased this account for $999, right? $999. But with $999, I have access to $200,000 capital, right? I'm still in the challenge phase, and that's why you can see what you see here, which is demo, right? I opened the company, I showed you everything last week. This is the logo of the company right here, Funded Next, right? I paid just $1,000 for this account. Of course, there are lesser accounts. So let's say you want to buy the 6K account. Most funding companies out there will take $50 from you, $60 from you, $70 for you for $6,000 account. So with little capital, instead of putting that $50 in a brokerage account, why not acquire the skill? Then put that $50 in all these funding companies, right? There are lots of them, reputable prop firms, right? Put it there, then with that $50, you can trade a capital of up to like $5,000 or $6,000. And imagine making just 5% of, let's say, $5,000, right? Time will not permit me to go into all of them, right? So I bind them with it. There's something called the trade copier. It's a software also. So if I place trade on one, it replicates on all of them, right? Replicates on all of them. So if once I enter a trade, you see it automatically reflects here. You see auto trade. I entered with an auto trader here, and I entered here. I took profit here. Stuffs like that. We will go into all of those details on the actual training sessions and all of that. These are some of my withdrawals from the firms I've traded with before. I have about 3 here. I forgot I would have added more from the other computer. There was the time I withdrew $4,000 here. That was around last year. These are old withdrawals. On this account, I withdrew 7K on this account, and on this account I withdrew $14,000. Right. So maybe for those that will join the training, I'll actually show you my other withdrawals. I'll add all of them on maybe the computer I'll be using for that particular session. Even after the training, you may need experience, right? So with the experience, we'll be trading together. So you gain that experience life, right? So whatever profit you make, will pay you some, take some. And that's the fun part, right? Doing what you like, getting the freedom, chasing that freedom, achieving the freedom while doing what you like. So is there any point in time where my strategy, I feel like it doesn't work? Then maybe a year may happen like maybe 3 times. Or maybe in worst case scenario, 4 times, right? That I'll go for using trades, right? So I always evaluate my trade on a 10 trade basis, right? So after 10 trades, I want to see how many did I lose? Am I profitable after 10 trades? That is what I focus on. So now if after 10 trades that happens, it's not because the strategy is now invalid. No, that's not the case. It may be that because there are different market cycles, there are times that price trends in a specific direction, whether trending upward or downward. And there are times that price will just, we call it consolidation in the market. That means price is moving sideways. It's not making any significant move up or down, right? So in that case, it may be that, okay, that is the current cycle. Let's say, and it's actually, it's very, very tricky when price is moving sideways, right? We tend to have more trading opportunities, right, when price is moving in a specific direction, up or down. But in a situation whereby price is moving in a side that is moving sideways, it is a little bit more tricky to like make money. So there's no other way price moves. It's either going up or down or sideways. If the market moves in 3 cycles, whether it's moving up or down or sideways, right? So let's say after trades, which is how I evaluate my trades. After 10 trades, if I'm not profitable, I want to look at my performance because I record all my performances, right? So I want to look at my performance. Okay, what's going on? Why am I not profitable after 10 trades? Is price hitting my stop loss before moving in my direction? Okay, maybe I need to widen my stop loss a bit. Okay, am I just losing? It has nothing to do with my stop loss. Okay, what's going on? Is maybe the market is probably moving sideways, right? Because it's difficult making money. It's difficult to actually make money when price is moving sideways. Okay, in the absence of no question, then once again, thanks for staying to the end of this webinar. I already gave the requirements to win our little giveaway, right? Just in case you are joining us maybe a few moments ago, we're going to be posting our unique link to our broker of preference, and the first 3 people to open an account and send in their account number to the group, right? The group is open for all. So the first 3 people to send in their account number are going to be considered the winner. And if you didn't win, well, hopefully we'll be hosting more of these, and hopefully you'll be our next winner.